Today, Household Financial Stress Update to September 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to his posts covering finance and property news with a distinctively Australian flavour. The latest analysis from Digital Finance Analytics to the end of September 2021 reveals that overall mortgage and financial stress moved a little higher in the month on the back of continuing COVID restrictions and the compression in household incomes. This, despite the opportunity many have taken to refinance their mortgages to a newer, lower rate, though offset as larger new loans are being written at higher loan-to-value and debt-to-income levels. This is based, of course, on data from our rolling 52,000 household sample. At the aggregate level, mortgage stress is now impacting 42.4% of borrowing households. That is a record, and a pretty sorry one at that. Now, just a reminder, we define mortgage stress in cash flow terms, comparing income from all sources for a household, including salary, investments and government payments, against outgoings, including mortgage repayments or rental repayments if renting, as well as other outgoings, including non-discretionary items such as food, fuel and council rates. If there's a deficit, households are flagged as stressed. In practice, they'll dip into savings if they have them, or draw down additional credit from credit cards, personal loans, or even use buy now, pay later services or payday loans and other sources. And some will also borrow from families and friends. It's worth noting that many will have assets such as a home or investments, so they have the capacity to manage their cash flow pressures, but a substantial number of households have less than 1 month's available savings to tide them over. And stress is grinding on and on. Currently, many under pressure are seeking to refinance their mortgages, to draw down additional equity thanks to rising prices where that is possible. But of course, if the behaviour does not change and incomes do not rise significantly and quickly, this is only a temporary fix. Often, the ultimate path will be to sell their property, but most will do all they can, including borrowing more, to avoid this. Around 10% of households in the stress group have traded off buying less food in order to safeguard mortgage repayments, and around 15% have cut back across a number of spending categories, including dental and medical, to keep afloat. Now, looking at the data across the states and comparing this with last month, we see a rise in mortgage stress across the ACT, New South Wales, the Northern Territories and Victoria, with a total of 1.57 million households in difficulty across the country. Stress eased in Queensland, South Australia and Western Australia, and remained about the same in Tasmania. Stress was highest in the Northern Territories at 56% of households, but remember that's based on a very small sample count, followed by Victoria, where the continued lockdowns are taking their toll. Turning to rental stress, South Australia apart, we saw rises in all states, with 38.65% of renting households, or 1.97 million households, in difficulty. Some have been facing rental rises at a time when government support is being withdrawn and working hours are still being crimped by the COVID restrictions. Property investors are also continuing to struggle in some areas, with high vacancy rates, rising costs, including strata fees, and an oversupply of properties potentially coming on the market for sale in the high-rise sector. Overall, 24.9% of investors are underwater, and many are planning to sell into the spring and summer as lockdowns ease back. Investor stress rose in New South Wales, the NT, Victoria and Western Australia, but fell in South Australia and Tasmania, with little change elsewhere. New South Wales and Victorian metro areas were the hardest hit, thanks to COVID. Overall financial stress, which is an aggregate measure across our indices, rose to 39.74%, or 4.3 million households with some financial pressures. This makes the point that while some households are indeed doing well in cash flow terms, others are not. Now, if we look at our segments, the segments are designed to look across our households based on a range of demographic and financial factors. This enables us to examine where specific groups are being impacted. Much of the pain is being carried by young growing families. In fact, 77.5% are in mortgage stress and 42% are in rental stress. And those include many recent first-time buyers. They stretch themselves financially to enter the market and in reaction to recent government stimulus measures such as Home Builder. Unfortunately, many are finding that the contracted cost of a home and land package are now rising due to higher input costs, including materials and labour. Those who settled in the past 2 to 3 years are finding the costs of living are rising much faster than the official CPI, suggesting that inflation is alive and well in the real world. However, stress resides across many of our segments, including affluent households who are often leveraged across multiple properties, first-generation Australians, which we call multicultural establishment, and those on the urban fringe in the new fast-growing estates. Indeed, there are more than 422,000 households in the disadvantaged fringe segment. That's the largest cohort. Rental stress has leaked out into the suburban mainstream groups too, which includes families with growing children and young adults. Some 320,000 have rental stress difficulties. The point we make here is that financial pressures are widely spread across income and social segments. Now, if we look at the postcode level analysis, we can list the top postcodes across our stress categories, sorted by the number of households impacted. This is actually a more reliable method than the percentage of households, as some postcodes may have small overall counts, which would distort the percentage analysis. Mortgage stress is highest in high-growth corridors such as Narrow Warren and Fountain Gate in Victoria, postcode 3805, which has more than 10,100 households in mortgage stress. Working down the list, as well as certain regional centres such as Toowoomba, we see many other high-growth areas also showing up. Rental stress tells a similar story. And investor stress is more concentrated in those areas with high vacancy, high-rise property, for example, Victoria 3000 in Melbourne or Surrey Hills 2010 in New South Wales, as well as across the high-growth corridors. Now, one of the most powerful ways to analyse stress is our Geo Mapping. Here is an example of Sydney, and I'm looking at Fairfield pretty much in the centre of the screen, and you can already see that the orangey-reddy shades are the areas with higher levels of stress, and that includes a number of Western Sydney suburbs. As we pull out, we can see a quite significant footprint, particularly in Western Sydney. And as we come further out, we can see that other areas of Sydney are also somewhat affected, again, particularly over the area towards Campbelltown. Closer into the city, things are less negative, but even there, we do see some pockets, for example, around Bondi and up in some areas of the northern beaches. The point I want to make is that mortgage stress isn't just a Western Sydney suburb problem, it is much more widely spread. Now, if I do a similar journey based on Melbourne 3000 and begin to pull out once again, we see the same patchwork story with regard to mortgage stress. There are a number of areas in and around Melbourne that are considerably more stressed, and as you pull out, you can begin to see some of the usual suspects, both to the east and the west of the city. Places like Melton and Wyndham, for example, over towards the west. And as you pull out further, you can see areas, for example, down towards Dandenongs and also north of Melbourne, and also north of Melbourne too. And it's also worth reflecting on where the high levels of COVID infections are raging at the moment. There is a very high set of correlations between the high levels of mortgage stress and high levels of infections. And if we pull out a little further, we can also see that some regional areas, for example, Ballarat, is also on the list. If I then turn to Brisbane, and again we start in the centre of Brisbane and pull out, we can once again see a somewhat similar story insofar that there are the odd pockets of stress. But as we pull out further, we begin to see some, again, of the usual suspects. Some of those are areas that you perhaps would not be surprised to find are on the list, like Toowoomba, Ipswich, places like that. But also it's worth noting that there are some pockets down towards the Gold Coast and also up north too. This is another patchwork quilt story, and whilst overall levels of financial stress in and around Brisbane are somewhat limited, in other areas it's much, much more significant. If I then do a similar journey from Adelaide, we once again find a very parallel story with some patchworks, some areas where there are considerable issues, and others where households are much more protected from mortgage stress. One of the hot spots is north of Adelaide up towards the area of Salisbury. If I start then in Perth and do a similar journey, once again, another patchwork, we do find that close into Perth things are not too bad, but as you pull out into the suburbs, particularly to the north and the south of the city, you do start to see some troublesome statistics. But the most significant levels of stress are significantly north, up towards Wanneroo, for example, or if you look south as well, along the coastal strip, you can see some evidence of significant financial stress. Now, Hobart has some stress. Of course, the total number of households involved will be a lot lower, simply because of the lower population density, but nevertheless, again, it is possible to see some variations across the postcodes as we pull out, and we can see that north of Hobart in particular, there are some troublesome areas. In and around Hobart, one of the main challenges is that the costs of property have accelerated considerably relative to incomes, so many households are definitely in some difficulty. And so finally we look at Darwin, and again, of course, we have low population densities in the Northern Territory, but nevertheless there is some evidence of financial stress even in the Northern Territories, and quite a lot of that is sitting close into Darwin, as well as out in some of the regional centres. So it's worth just reflecting on the fact that wherever in the country you look, you are going to see evidence of mortgage stress and financial stress. And just before I finish this presentation today, I will just mention that we do have our portal running. This is accessible to people who subscribe via our Patreon program, details in the links below, and those who do subscribe are able to get quite a lot of information about what's going on with regard to mortgage stress. So, for example, if I look up Postcode 2000, just as an example, you can then see information about how many households are in the particular postcode, how many of those are borrowing and renting, and what proportion are in financial stress. Unfortunately, in 2000, it's quite a high proportion. And then we break it out into those with mortgages, those who are renting, and those who are investors. And the tool also provides a map to show which part of the country we're talking about, and some price change projections based on where we are today and what might happen going forward. And we run through different scenarios, a bullish case, a neutral case, and a bearish case. And now that information is available for most postcodes across the country. So if I look up Western Australia, Perth, for another example, you can see then we show the number of households, and the overall financial stress is 57%. 43% of households with mortgages are in mortgage stress, 41% in rental stress, and 61% of investors are still having difficulties with their investment property. Now, that's, of course, a function of prices still being a lot lower than what they were a few years ago. And for those interested in subscribing to get the latest information each month, you can do that via our Patreon program. And in fact, in Patreon, we have 5 different tiers of membership. This is shown in Australian dollars. And the one that's relevant is the DFA Stress and Membership Zone, which is at 68 Australian dollars, or about 50 US dollars. And what that allows you to do is to subscribe to get access to our portal. And each month we put all the information in across our postcodes, including mortgage stress and the other categories that we examine, and also those future projections in terms of property price movements. So it can be quite a powerful tool. We have a number of people subscribe to that. So if you'd like to join us, simply go across to the Patreon program and sign up. Or if you prefer just to help us with a smaller contribution, there are also other levels of membership. Or if you really want to put the boat out, you can get the full survey data set from DFA each month. That, of course, is a lot more expensive because of the amount of work that's involved in putting it together. But for 68 Australian dollars, you can get information each month relating to the mortgage stress, the financial stress, the rental stress, and investor stress. And we also include some information there on property defaults and other things too, as well as the future value projections based on where we think property prices might run in our various scenarios. Now, whilst DFA doesn't offer financial advice, we can make some general observations. First, mortgage and financial stress has become endemic in Australia thanks to many years of bad policy and driven by easy credit and political influence. Overall ownership rates are falling, and more are going into retirement with a mortgage, while first-time buyers are buying later, and it can take up to 15 years to save for a deposit in some places at the moment. Secondly, when people are in financial stress, in the short term, it is possible to mitigate by drawing down on savings or loans. However, this can be a cul-de-sac unless people change their behaviour. Given easy access to credit, relatively low levels of financial education, and the must-have-it-now attitude, actually this is unlikely to change. Third, when people get into financial stress, they tend to ignore the problem, hoping it will be self-correcting. Given current low-income growth, this is unlikely. In addition, not many are factoring the potential in for future interest rate rises, which may well hit sooner than many expect. Next, mitigation of stress starts with an understanding of household cash flow. In fact, less than half of our surveyed households have a budget of any sort. There are a number of useful tools and apps around now. For example, look at ASIC's Money Smart website. Once this is understood, households can then prioritise their spending more effectively. A focus on avoiding and repaying high interest rate credit cards is also a useful approach, and be aware of refinancing to generate cash from equity, as without a change in behaviour, this is a pathway to an eventual forced property sale. And fifth, in terms of education, we believe there is a burning need to cover education on household budget-related issues at school, as we continue to see many who are unable to recognise their financial pressure, yet alone plot a path backward. And also, we don't expect genuine income growth to assist for several years, so there is no get-out-of-jail card. So, in the light of all this, and despite the unlocking that's now starting to happen in New South Wales, Our read of the situation is that we will continue to see high levels of financial stress across households. Not all households, but a significant proportion of households. And this can have a very significant dampening effect on the economy. Ahead, I think we will see this continuing unless or until incomes really start to grow in real terms, or the lending taps are turned back so that lower numbers of new buyers get in over their heads early on. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.